One of the most interesting growing trends in private equity is that of the continuation fund. This essentially allows PE firms to transfer their ownership and assets to the next fund or to a new vehicle. So rather than exiting a business and selling to someone else, in some ways, they're actually selling back to themselves. And on the surface, this might seem a little goofy or antithetical to investing, but it actually plays a really important role in managing a PE firm's portfolio. A really intuitive example is with something called single asset deals. Let's say that you're a private equity firm that's been holding this good compounding asset for a long time. And according to the closed-end nature of that fund, they may be required to start distributing profits back to their investors. But if this is a really good company that we want to keep ownership in, then why not continue our stake in the business? So we might sell our stake in this first fund and continue our ownership in the following fund. And this might actually be more common than you think. Maybe it's a really bad time to sell the company. Maybe the firm is too large that there's no other natural PE buyers. And maybe that company just wants to remain independent and never go public. Madison Dearborn is a private equity firm that has been doing this for a while. They first invested in search fund legend Asurion back in 2006. They essentially provide cell phone insurance and repair, and they kept investing or holding stakes in that company and moved their investment in Asurion into a continuation pool in 2018. And this strategy is getting more and more popular. About 13% of all PE exits in 2024 were in these continuation vehicles. And this is one of the largest drivers in the secondary market, with over $70 billion in 2024. Now, of course, this is not without its complications. It can be tricky finding a fair price for those who are selling and those buying in, and that's why it often involves a bank performing some kind of fairness opinion.